Ladies and gentlemen, welcome to It Starts Now, the happy hour for finance and business. My name is Stanley. I have a special guest today. I know this guy for quite some time right now, and I'm really excited to have him on board and have a in-depth conversation because he has so much knowledge. His background is really interesting. He graduated from City College as economic and business manager, worked for the banks, received the Series 663 and life insurance, then decided to leave the sector and pursue education. He works now for the DOE, teaching economics and finance classes, a world-class traveler. He's been to Barcelona, Milan, Morocco, Grenada. I don't even know what's in Grenada. But his stamps just keep going and keep going. And now you can add developer because he's working on a project for the property. Please welcome Rezaul Khan. Did I butcher?
Nah, that was good. Thanks for having me.
Okay, that's good. Rezaul Khan. I'm so excited to have you here.
I'm excited to be here, man. This is great.
Yeah. We happen to be in Buffalo. I'm going to just give a quick insight. We were in Buffalo. We were having a conversation. We were outside. And we got to talk about investment.
Right.
And one of the things that he brought up, and we were debating on what's a good investment, whether it's like trading stock market or being a investor in the property. And one of the things that he said was interesting, that I said, you know what, I would love to have you on the show and we can continue this debate because it was really good. He mentioned that we haven't seen the ripple effect of the COVID-19 and what's to come.
Right.
And you want to elaborate on that?
Yeah, I mean, I think what we're seeing is the very early stage of the financial impact of COVID-19, right? Like we have people. So when we talk about economics, just to give a little background, we always talk about some like indicators, like leading indicators, lagging indicators, right? So you have indicators that tells us where the economy is headed. Leading one always tells us where we are going. Lagging one kind of confirms where we are. So, but even then, for something like COVID-19, for us to see and understand the complete effect of it, it's not going to be now. It's not going to be in 3 months. It's going to be, 6 months from now, a year from now, even probably in like year and a half and 2 years, we will start seeing the impact because it is a ripple effect. For example, people who, and it could go both ways, positive or negative, right? Mm-hmm. For example, people who are not currently working, they probably will burn through their savings, right? And they're getting unemployment, but the income is not as much, right? It's obviously not going to match their 100% income. So they will burn through savings. They will shop less. They will buy less expensive things. Mm-hmm. That will in return impact the decision of the producers, right? Before you could get away with making a $1,200 phone because people were making that kind of money. So they will go for it. And going forward, they could even say like, you know what, let's do a $1,400 phone or $1,600 phone. But now they will think twice about it. Like, do we really have that market anymore?
Right.
Can we come with a $1,400 phone and sustain the sales? So they will scale back. And obviously, when they were going for high quality products, or they were coming up with these $1,400 phones, or they were selling a lot more, like, before they were selling 5,000 phones, now they were selling 10,000 phones, 10,000 units. But with COVID, their sale will go down again.
Yeah.
So they won't produce as much. They won't grow as much. They won't rent out a new factory. They won't hire more people. So what happens? In returns, less people are getting jobs. The real estate prices will suffer, right? Because you don't have all these companies looking to expand anymore. Mm-hmm. And when that happens, what happens? People who used to work in construction developing these real estate places, they're not getting as much business. Materials to develop this real estate you are not selling as much. And if you're not selling that as much, then those factories are not
Yeah.
expanding. So you're just gonna keep on going backward. It's a ripple effect. That's what I meant. That, and by the time, like, we will start seeing, but to fully understand how much it impacted the economy, it will at least take 6 months, year, and that's when we'll really understand how much we got hurt by it.
Yeah. You definitely see the economy. There's going to be changes in the economy. But I still see people online. Like, there's long lines to buy Jordans. Granted, is like you said, it's going to take anywhere between 6 months to about a year. But you still got that going on. Why isn't it that people not taking it as seriously, or not projecting the future to say that I need to start saving, or I need to do better investment?
I think that's in general just how we are, the education, being financially responsible, right? We don't, we, it also could be that you were never in this situation before, right?
True.
So you
True.
don't understand what to do in this kind of situation. Like, somebody who lived through the Great Depression or another recession would understand, like, oh wow, when there was the economy crashed or there was a financial crisis, this is what happened to me. So now that another crash is coming or is happening, let me be more conservative, right?
Right.
So there are people who are, but what you're saying is maybe a little younger generation, or a generation that never seen this kind of economy, or never been in this kind of situation where they understand that, okay, this is when I should cut back a little bit. But it's a double whammy. It's like a double-edged sword. In situation like this, when people do tend to not spend or save, that actually in return hurts the economy,
Yeah,
right?
it does.
Because if everyone just gets scared and you hold on to your money,
Yeah.
and you don't go out and you don't spend, in again the ripple effect, because if you're not going out and to the restaurant and
The
spending
economy's
money,
not growing.
right, economy's not growing. And like the whole thing with this stimulus check, it's called stimulus check for a reason.
Stimulate.
Because, yeah, to stimulate the economy, and the government gave us money so we would go out and spend and kind of like jumpstart the economy. But a lot of people, on the hindsight, a lot of people were concerned, like, oh, maybe I should save it.
Right.
Right. I don't know if you asked me that question, like if people should save that money or they should spend it, or someone asked me that question, like if government is giving this stimulus money, should we spend it or should we actually save it, not knowing what's to come? But if we all save the money, then it's not stimulating the economy. So I think that's what it is. Also, the other side is rich people who make so much money. For example, someone who's making, let's say, $5-6 million a year. They're at a lifestyle where they're probably spending $400,000-500,000 a year in expenses. To them, if they're making 5 million, 10 million, or 4 million, if they're spending $400,000-500,000 expense a year, they won't cut down their behavior. Like, their behavior won't change, because 6 million, 7 million really not going
It's
to
not
make
a big difference.
Yeah, it's not going to make a difference. So they will continue to spend the way they're spending. So you will see a certain group of people will continue to spend, and certain group of people will cut down. So for example, teachers, right?
Right.
We didn't see any reduction in income. Right, we're working from home, and there are a lot of people like that who's working from home. They didn't see any reduction in income. But if you had 4 people in a blue collar job, and now 2 people working because 2 people lost their job, for a while they probably sustained their expenditure habit because they were getting the unemployment, they were getting the extra 600, so they could have still sustained their lifestyle. But once they stopped, now a month or 2 months later, when the bank account is going to shrink, they will think twice about spending. So I think that's when you will see people kind of cutting back, when the unemployment is kind of winding down, when that second person is burning through their savings, or they thought they would get a job again and they can't replace their job, or that job is gone. A lot of industry job is gone, right? Like in hotel industry, they're probably not expanding or they're not hiring.
Yeah, that's true.
Air travel.
Air travel. Right. When we was in Buffalo, we were at a hotel. I don't want to say the brand name, but we are accustomed to a certain style when we go in,
Right,
right? A
right,
certain service when we
right,
go in, and when we got there, because
right,
we're both members of the same
right,
hotel,
right,
and when we got there, one of the things that they said, we don't have daily house cleaning.
right,
Like you,
right,
that's something we haven't heard
right.
of
It was
before.
it was
Right, it was
shocking.
shocking.
Yeah.
Right, we don't have daily house cleaning that you have to schedule a time for them to come
Right,
in and clean.
right,
So to your point, yeah, people are cutting back.
right.
Um,
Even
and,
the breakfast.
yeah, even the
Right. Like,
breakfast, right?
yeah.
It was
Shocking that a hotel chain like that will provide that kind of breakfast.
yeah, and when we mean that kind of breakfast, like they gave us like lack of better words, a doggy bag.
Yeah.
It's like there was nothing special about it, and then
Right.
you didn't have that many options. Just like
It was just one thing. If you like it, take it. If you didn't,
yeah,
too bad.
and that was it.
Yeah.
But I really want, like, I want to touch on the school thing, but before then, I just want to say, for me, I like to save for either a rainy day
Mm-hmm.
or I like to save for an opportunity, right?
Right.
When there's a tragedy, or when there's a pandemic, or when there's an economy that's low, even Warren Buffett, I think he was quoted for saying that when there's blood on the street, that's when you buy.
Mm-hmm. Absolutely. Absolutely. Actually, I teach that to my kids too. The best time to buy is it's like think about a t-shirt that costs $100 and everyone wants it. Everyone wants it. That's the hype, right? Like Tesla is a hype.
Yeah.
If you buy it at $100, you can't go any higher than that. Maybe 120, 130 if it means something more valuable. But if that t-shirt all of a sudden for one day goes on sale for like $50,
Yeah.
that's your opportunity to make money, right? So there's two ways to make money from investment, stock investment. One is the capital gain, which is basically you buy low, you sell high. Or the other way, if you do short sell. The other one is if you're just looking for the dividend. You buy a company that will pay you dividend, you hold it long enough, and you start, getting the profit share.
Mm-hmm.
So absolutely, you're right. Like,
Yeah, but you don't think that stocks is a good investment right now?
Okay, so given being in licensed in certain Series 663, there were certain, and working in a bank, there were certain things that were taught to us. Like, in order to do investment, like even right now, like when you look at the way people are investing, and a lot of the times the market is so volatile, and one of the things you will keep seeing people talking about is Robinhood traders.
Yeah.
Right?
Yeah.
And the reason the market is so volatile is because of Robinhood traders, because it's not making sense anymore. You have a company like Hertz going bankrupt, but their stock is still trading like 50% or sometimes even 100% more than the price. What was the price? The last closing price, which is unheard of. Like, why? Right? They filed bankruptcy. The travel industry is still not, good enough to recoup from that kind of loss. But here you have a company that you would expect in a normal condition to delist. It's thriving, right? So, and again, and that's like Robinhood trading effect, because you don't know. And same thing with some of the other, there were like 5 or 6 stocks during the whole BLM movement. Someone started, buy black.
Right.
And then all of a sudden you have these companies that no one even heard of. All of a sudden, like CMB, and there was another one, all of a sudden are going 300%, 400% and skyrocketing, right? You can't predict that kind of price. If somebody sat there and said, oh yeah, I knew that was going to go 400%.
Yeah.
I don't know if I would believe that, but company like Tesla or Amazon or, Netflix, like you could see like, okay, this is a company, eventually there's promise.
Right.
So they will grow, you invest, and you wait for them to grow into a big company and you cash out, right? That's the normal trading. The overnight, this whole mentality to get rich overnight, I think it exists more in the Robinhood traders. They want to trade today, get rich tomorrow, right? And it makes the market very volatile. And going back to it, I have a few friends like, hey, how's your day? Oh man, I almost died last week, right? Like crazy. What happened? Oh, my stock was going down so much.
Because the other thing with Robinhood, to your point,
yeah,
short sell.
they're doing a lot of short sales,
Yeah.
and that's dangerous because when
The
you buy
options.
low,
Yeah.
it's predictable because you will sell when it goes high, and you could control it. You
Right.
sell it when it's high enough for you.
Right.
But with shorts, once it goes the other way, like if it keeps going higher and higher, there's no way to come back from it unless you wait it out that it comes back down again.
Mm-hmm.
Maybe then you could recoup your money. So it's very risky. It's riskier than long hold. But what I was saying is and wasn't there a student, a young individual who committed suicide because he misunderstood his Robinhood. I think he did options trade.
Right, option trade. He lost a lot of money.
Apologies, I don't know the exact situation, but I think it wasn't even true. I don't think he even lost it, but it was an unrealized loss.
Right.
And unrealized loss. So and he committed suicide. So you see, when you see that kind of thing, like you have to kind of take back and go back to what we were taught when we were going to advise people in investment, that investment is not for everyone, first of all.
Yeah.
Right?
Yeah.
And you have to understand your risk tolerance.
That's another thing I was going to say. You have to have some kind of stomach for it.
Absolutely.
Yeah, and
you have to know what your risk tolerance is.
You have to know that, and that's why it's important to have a number.
Mm-hmm.
Like I'm okay with losing, and I tell this to friends. Like if I lend you money, I'm only lend you what I'm comfortable with losing.
That you never give it back,
yeah,
will be okay.
Yeah, I still want it back, but I'm
right,
just saying,
you want it back.
I'm comfortable enough to say, okay, I'm willing to lose this much. Right. And you have to, and that's the same thing with trading. You have to be comfortable with the amount of money that you're willing to lose. So, and a lot of people don't have a percentage in mind too, because there's a certain, it's like going to the casino, right? You start winning, but then you have to know at what number you're going to walk away from.
Right.
Because then you could lose everything. Right. If you don't have that number for you to say, okay, once I reach this number, I'm going to walk away, and be disciplined enough to walk away. Right. All right. That's the other thing. But because you think like everything is volatile, there's a risk factor. What would you suggest is a good investment in a time like this?
No, I mean, don't get me wrong. The market was really great for investment. I myself invested, but I think like it took me a while to get back in the market. The last time I was in the market when Washington Mutual filed bankruptcy, and I lost like a lot of money in that one. And I kind of like, whatever I was taught, it kind of made sense that, you at work and you seeing these stock prices going down, and if you can't stand there and say like, okay, you know what, I took this risk and I knew the risk I was taking, and I'm just going to lose this money, there's nothing I can do about it at this moment, that's when you're ready to invest. Or the money that you have is good for investment. So what I'm trying to say is that you should invest, but you got to make sure everything else is well put together before you have investable assets. So basically, like, if I lose my job, can I pay my rent for at least 6 months? If I lose my job, can I eat for 6 months? Do I have money for clothing? Do I have money for this? Do I have money for education? And all that, when all that's taken care of, okay, I have this extra $5,000 that I don't really have any need for. I probably will need it in 10 years. Then it would be a great idea to invest and let your money grow, because you don't want it to just sit. At least, with inflation and everything, you want to recoup some of that. Great time to invest. But if you are just starting out and, all you have is a $3,000, that's all the savings you have, and you are still kind of paycheck to paycheck, and you're trying to put that $3,000 in an investment, that's when you're going to panic the moment it loses a little bit. And the worst thing you can do is just panic when if the stock price is not going the way you predict it, because it's very hard to predict. There are few people can predict. Few people gets lucky and they say like, oh yeah, I predicted it. But you have to have that risk tolerance, like, okay, if it goes the other way, then I'll be okay, or I could at least hold on to it until it comes back. So a lot of people will invest, the next day it goes the other way than they hoped or predicted. They get all jittery and they want to cash out. They want to sell it because they think that, oh, let me sell it before I lose even more money.
So that's the emotional piece that some people don't have control over, right? Because the moment they feel like anxiety or anything that's too much pressure, they panic and make a panic decision. I got a mentor, and the reason I'm bringing this, I got a mentor in Florida, because his foundation is so secure that not only has he has a long, his cushion is very long, right? He's very comfortable. So when the pandemic happened, there was no changes in his budget because everything remained the same for him, right? So when everybody else was going crazy, his lifestyle still remained the same, hasn't changed because number one, not only that he has a good amount of cushion, right, but he still live below his means, right. He doesn't really need much to survive, and because of that, everything is just. I mean, he still splurged because don't get me wrong, because sometimes I'm like, this guy just bought something and I'm like, you able to afford to start a new project for himself, even while things are going on, spending thousands of dollars just to develop a personal project of his, but he could do that because he's put in that time and he has a cushion enough to say, all right, I my lifestyle hasn't changed. I can still go ahead and do certain things. But his investment started early. Right. If you have $3,000 to your point, I don't think that no one should just jump in. Yeah. Because now you're not. It's not even a calculated risk. It's more like you're just gambling. Right. And I don't think that's good.
So I think that's the issue. A lot of people, and even my students, a lot of the times they will come and they're barely 18 and they're always talking about investment. And it's okay to invest if you have some extra money, you want to learn, you want to get into it, you want to try it out. But the moment you start putting real money and that's all the money that you have so far, it's not advisable to take that kind of risk, right? Because there are other things that you have to do in life. Like you're going to miss out. You lose $3,000. That $3,000 you could have bought a car. And a lot of people say like, maybe you don't need a car. You live in the city, but some people wants to enjoy the car. Right. You have perks. So that's another thing. I think everything. So I'll give you an example. Some people will be like, okay, if you have $100,000, don't buy a real estate. Instead, invest in a business or invest. Let that money make money for you. But here's the thing. You have $100,000. You put it in a business. The business gives you $2,000. And you use that $2,000 to pay rent. And you're like, see, now I don't have to pay out of pocket because my business is paying for it. That's true. But you will be paying $2,000 for the rest of your life, right? 30 years later, you're still paying rent. But if you were able to secure a property, and that's we're talking about it because you're saying like, is it really worth it? Yeah. My thing is like, you pay.
Well, before you get into that, my concern was, should I, or does it make sense in this pandemic to place $30,000, $40,000, or even $50,000 into a property right now as a placeholder when I could use that money or hold on to that now? You don't know who's going to pay rent. You don't know what the outcome is going to be. Right? If there's going to be a downturn or even worse downturn, to have your money placed there.
A valid question. And I actually was having this discussion at work today too. And I think that's something a lot of people are wondering. Like, if I have the money, do I, invest in a real estate, because you don't know what's to come. And I think there are two different sides to real estate investment. One is you are investing for an investment property. Right. And the other one is you are spending the money for your own property, like something that you will live in, right? Right. I think it's two different things. Like, for example, you are absolutely right. If you already have a place, or you live in New York City, 2-bedroom, and you're paying $900, which is like unheard of, right? Yeah. By all means, keep that. There's no reason to buy, spend $100,000 a down payment for a property that you're going to pay $2,000 mortgage and all that. If you have a $900 rental 2-bedroom, maybe it's better to keep that and invest your money somewhere else. Or if you already have a property where you're living in and you're paying your mortgage and stuff like that, and now you're wondering like, okay, I have 100,000 additional money, should I, does it make sense to buy another real estate investment, because are they gonna pay rent?
Right.
That was what we were
That was
talking about. That was
yeah.
concern, and it's a valid concern because during pandemic or whenever we have situation where people are losing jobs, one of the industry that will suffer, you know, is real estate. People don't want to pay rent, right?
Right.
How can they pay rent? They
Right.
don't have income. They just lost income, and especially people who are renting, they live, especially in places like New York City where your rent is like sometimes 80
It's
90%
like
off your,
mortgage.
yeah, it's 80
Yeah.
90% off your paycheck. The biggest expense we have is rent.
Mhm.
You make $3,000 a month, you probably pay $2,000 just in rent.
Correct.
Right? So when you are living paycheck to paycheck, even if you lose one paycheck, it impacts your rent.
Right.
So we do have issues like that in big cities, big expensive cities, whether people are going to pay rent or not. And then you have these laws where people could live in your property without paying rent for 6 months, 7 months.
Mm-hmm.
By the time, you could actually do something about it. So sometimes people will take advantage of that as well. But more often it is because people just don't have the ability. Even if they want to pay you rent, they can't. And then it hurts the person who owns the property because they also have mortgage to pay, and they pay mortgage when they get rent. So if they're not getting rent, they can't pay the mortgage.
Correct.
That's why, in New York, there were a call for, not only rent freeze, but also asking banks to kind of put a pause on mortgage payment too. So
Right.
then the landlords are also not breathing down the tenant's neck. Like, okay, I need the money because I need to make my bill payment.
Correct.
So yeah, you're right. Should we invest in a real estate investment? Because then it's an investment. But what I was talking about is, if you do have 50,000, that's all the money you have right now, $50,000. You're renting, right? No matter what, you have to rent. Okay, you could get away 6 months not paying rent, but then you're gonna have to go somewhere else. It shoots your credit, so then it's going to be harder to get another apartment. So sometimes you probably want to pay rent on time. You move to another apartment, you still have to pay rent, and once you move, your most of the time the rent will increase. It never goes down, right? Like if you're renting a 2-bedroom for $1,800, you can't really find a 2-bedroom for $1,500, right? It'll be $2,000. So, and the way rent is going higher and higher, the way it works out is the rent will always be equal to the guy who owns it, his mortgage payment. Right. If his mortgage payment is $4,000, he's not taking $3,000 from you.
No.
He will charge you $4,000 because he needs to make his mortgage payment.
Right.
So in reality, when you're renting, you are basically paying somebody else's mortgage, right?
True.
So 30 years later, that guy will have a building that will be worth $800,000, and you helped him pay for it. And then he will continue to make rental income while you're continuing paying rent and nothing off your own.
Right.
So my point is that if that's all the money you have, yes, you could invest in investments and business and stuff like that, but you're still paying rent, right? And 30 years later, if you invested the money, so what we're talking about is if you invest the money to buy a property, and instead of somebody paying someone else's mortgage, you pay your own mortgage. And yes, it'll be this. Here's few things. Obviously, if you're paying $2,000 rent, don't get a house that's $4,000 mortgage payment.
Correct. That defeats the purpose.
Right. That defeats the purpose. If your rent is $2,000, try to get a similar apartment that's maybe the most $2,200 or $2,300, right? So your payment is about the same.
Right.
And then a lot of people will say, like, what if I can't pay? Well, what were you gonna do if you couldn't pay rent?
True.
Right. We will always find a way to live somewhere, just like food and shelter. We need these two things we need. And if it really gets that bad where you can't pay, you lose out your initial investment. You could walk away. The bank will take over the property. So you lose your initial investment. But that's worst case scenario. So there is a way out.
Yeah.
It's not like there isn't.
You got to figure it out. You got to figure out to find a way to make the payment, even if you have to go work for Uber.
Right.
Or do whatever you need to do for the extra hours, because long term, right, you were looking at it long term, it'll pay out having to own your own property versus
that's why that sense, like, I think the primary place you should definitely, I think it's definitely a good investment, right? You get your primary place, you put down the $50,000, so you keep on paying rent. instead of rent, you keep paying mortgage, and 30 years later you have this property. And and you will see, like in this country, a lot of older generation suffers sometimes for the very same reason. When you depend on social security and pension stuff like that, you take majority of that, and if you're still renting, you pay rent, then you don't have any money left over for anything else. But when you are 60 years old, if you have a place, even if it's 1 bedroom, 2 bedroom, you have a place that's fully paid off by that time, then you could rely on social security. Even if you get $2,000 social security, or $1,500 or $1,200, you could survive, right? A lot of the times people say certain things and they think it applies to everyone,
Right.
but nothing applies to everyone. Like everyone's situation is different. You have to
Correct.
understand your own ability. You have to understand your own financial situation, where you are. You have to understand also what's important to you, right? Some people may be okay paying rent for the rest of their life, because they don't want to be settled down in one place. Maybe they want to settle down when they have a family,
Right.
because they don't want to get a small apartment. They want a big house, and that's okay, right? We're not talking about everyone should. There's no one for all. There's no you graduate, you save a little bit money, you buy an apartment, and everyone should just follow that step. That's not correct. Everyone's situation is different.
Correct.
Some people may want to live in New York City for 6 years and move to California, live there for 2 years. If that's the case, then buying a property may not be the right thing, right? Because when you buy a property, first few years, you are only paying interest. You don't really build that much equity unless the property value goes up.
Correct. And I think people miss that point. They don't realize that you don't start hitting the principal until later.
Right, because it's like a bell curve. The first one is if you make a $2,000 payment, like $5, I'm exaggerating, but only $5 going towards your principal.
Correct.
You're paying the rest $1,995 to the bank, and they're taking their interest. It's only later down the road where you hit principal more than the interest. So obviously, if you're gonna buy a property and sell it in 5-6 years, and this market, your capital is not going to it's not going to be that much capital gain, then you're actually losing money, right?
Correct.
So you wouldn't buy. So that's what I'm saying. Situation is different. Everyone's situation is different. But what we're talking about is someone, you graduated, you're young, you have the money, you have about $50,000-$60,000. You're looking to stay in an apartment for at least 10 years, 15 years. Should you rent? Or should you invest that money? To me, if you're paying your rent and you could get an apartment with $60,000, that would be the same as your rental. And it's a place like New York City where real estate is only going up.
Yeah.
To me, it's a much better investment, and a safer investment, because you control the narrative of this investment, to get an apartment. So I have a coworker, for example. She was, I have two coworkers. One is young right now, and we're debating whether she should buy an apartment or not. And there's, someone was saying that no, it may not be. Why don't you save your money? I just told the other coworker that they should sell their apartment and go buy a house now. My thing was hold on. You told one of the coworkers who has an apartment to sell the apartment, cash out, and buy a house.
Yeah.
She wouldn't be able to do that if she never bought an apartment when she was young enough, right? Because when she was young, she invested whatever money she had to buy this apartment. Over the past 15 years, her apartment grew in equity, and she paid down. So not only because she paid money, it built equity, but also the price of the apartment, she bought it for let's say $125. Now that apartment costs $225. So you have that $100,000 capital gain, right? And you real estate gain, and then you have the payments that you are making. So now you are able to sell the apartment, cash out the equity, and go put a down payment for a house.
Right.
Imagine if she was renting this whole time.
She wouldn't be able to do it.
She wouldn't be able to.
Yeah.
And the money wasn't saving, because whatever you're making, you're paying rent. And that's the thing. It's like every money you make, you pay rent. Every money you make, you pay rent. You're paying $2,000 rent, $3,000 rent every month. How are you supposed to save for a house? So this is a nice way to build equity, because instead of paying rent, you are paying for your own property. You're building equity that way. Plus, if there's a price of the real estate is going high, you make some money out of that. Now she's in a position to sell this apartment, cash out on the $150,000, $200,000, take that money, put in a down payment, match the similar mortgage payment for her house and upgrade.
Yeah.
Right? And that
So basically, she has more now. She has more leverage, right? Because she has the money, but now she has more money saved back into the same bracket when it came to the monthly payment,
right.
right? So she's really continuing, but now she has a bigger pot.
And a bigger pot.
Yeah.
And this is the same thing with I'll give you another example. Someone bought a house in 2009 for $550,000. That house is now in 2019 is worth $1 million, right? You don't have to live in $1 million house. You could now cash out,
Right.
take the $1 million, pay off your entire mortgage, and still have about $300,000 left over or $400,000 left over to buy a house mortgage free, right? You wouldn't have been able to do that if you're renting this whole time. So
Right.
it gives you more leverage.
Right.
And the reason I'm saying that, it all depends on where in life you are,
Yeah.
right?
And
Like,
what you're capable of doing.
what you're capable of doing, because honestly the monthly payment is not that much. If you take out a 500,000 right now, and that's what we're talking about, like, is this a good time? I think this is a very good time
Because the interest rates are low.
the interest rate is so low. A 30-year you could get around 2.5, 2.9. The payment would come out about $2,000 to $2,500, right, on a $550,000 loan. And in New York City, if you get a house for $500,000 now, it's safe to say that that house will be at least worth, $700,000-$800,000 10 years from now, 15 years from now, right? So it's a nice way to borrow money from bank at a cheaper rate and build equity and have a savings that you would have otherwise be paying for someone else anyway. Right. So if you and this is where I meant, like, don't try to take more responsibility than you would have. Stay within your budget. If your rent was $2,000, try to get a place that the mortgage payment would also be $2,000.
Right.
And build that equity, and anything you could save on top of that is extra savings. And when you're ready to upgrade and move on, you could cash out
on it.
and on it. So now, if you already have a property, you have a good savings to take you at least 6 months, and then you still have money left over, by all means, get into the stock market. And you will be a better investor when you have your house in order, when you have a roof over your head, when you have food on the table, when you know that you have 6 months worth of money to, like, last you. Then you have $20,000, $50,000 that you put in a stock market. The market is not doing good, or it goes low. You will have the stomach to kind of ride it through.
Right.
Because that's not everything to you.
You're right.
Right. So, for example, a lot of people were panicking when the stock market was going down, and you never know when it's the bottom.
No, that's one thing you never know.
You never know when it's the bottom.
Yeah.
You only know when it's the bottom by the time it's too late, when the stock market is coming back up.
Well, prior to the split with Tesla, I remember we was at 18. It was at 9. It dropped down to, I believe it was like 920 or something like that. And I was watching it, and I said, I think it's gonna go lower. And I waited. The next day, it's gonna go lower.
Yeah.
And the day after that, it just jumped, and it just kept jumping all the way to, it got to like 2,000 and plus, and then they did the split. But to your point, you never know what the bottom is. You think you could time it,
right?
But you can't.
You can't really time it. I mean, you could call certain things, and these are the people that are best in the industry. You could call, like, okay, there's a pandemic coming, and you could kind of predict, okay, if it comes to, the United States, it will impact the travel industry. It will impact positively the food industry, like supermarkets not like that, because people will stay home. They will go to the supermarket. They will shop more. It will impact negatively the restaurant industry. It will impact negatively the travel, air, the car rental, hotel, that kind of industry. but it will also impact positively, like, Netflix, because people are staying home, they will stream more, right? Zoom, DoorDash, Postmates, Grubhub, right? Like those things will strive. So you could kind of make that kind of decisions, right? Like, and predictions.
Like Amazon and Walmart.
Right, Amazon and Walmart, people will shop more, right? So you could, like, toilet paper. Not that it's gonna be a scarce, but like, that people, when they stay home more, they're using residential grade toilet paper more at home, right? Because now you're not 8 hours at work, because majority of the time you have your lunch, you do your bathroom and like your private things. And it was actually interesting because a lot of the office supplies suffered because people weren't buying office supplies, janitorial supplies as much, because no one was using their restroom, no one is using the coffee room. So people buying more residential grade, right? So the dynamic will shift. So you could make that kind of, assumption, prediction, and invest. Those are okay, but you never know how low it's going to go, or when it comes high, you don't know if this is the highest or not. So that kind of thing, no one can predict, so you have to ride it out, right? People who were at, this pre-COVID, you were at a high and you thought you were good, and all of a sudden it dropped 1,000 points, 2,000 points. You will panic if all you had was $20,000 and all the money in the stock market, right?
That's true.
You're gonna get cold feet. You're gonna be like, oh my God, I thought this was the lowest, but it keeps going lower, and you might want to sell it because you think you don't want to. At that point, you think you're minimizing your loss, right? Like, okay, let me
take a loss.
Let me take off the. Let me take $100 loss, then $200 loss later.
Right.
So you try to get out, and a lot of people got out like that, right? And look, what, 4 or 5 months later, the stock market is back to pre-COVID.
But I think that the stock market constantly tries to correct itself.
Of course.
And the problem is, you don't know where it's at the point where it's either gonna be a bubble,
right,
and it's gonna pop, or if it's gonna finally correct itself and then just continue to shoot up.
Right.
Like, and that's the thing to what you were trying to say. You can't predict that. That's not something you can predict, but you know that that's a possibility.
Right.
Possibility this could be a bubble and then it busts.
Right.
Or it could just automatically correct itself and then it starts taking off from there.
Yeah, and if you look at, the historical price of the stock market, it crashes, but overall in the United States, we are on a, we're only going up.
Yeah.
Even with the declines and the downs and the stock market crash, historically we are only climbing up. So eventually it will climb up. You just gotta have the stomach and
ride the wave.
And then also obviously your portfolio diversification, your asset allocation, all that comes into play. If you're investing in one industry, don't put all your eggs in one basket. It's a very common saying in investment. You have to diversify your portfolio, so make sure that and that's why stock investment is good, but my would be like index fund could be even better for someone with that kind of small amount of money, because the best way to diversify is through mutual funds or index funds, because you're basically getting a small bites of the whole stock market rather than relying only one or two companies.
Correct.
So there are ways to invest, and there are ways to stay safe. And I think a lot of people don't explore that option because they have that get rich quick mentality. And that's when they get into trouble. Hey, if you have a $2,000 and you're ready to gamble, because at the end of the day, let's call it what it is. It is a gamble.
It's a gamble.
And you think you are able to call the shot that yes, this company, I have a good feeling it's going to do really good. And
I think if you do your research, right, things will work out. But you definitely got to do your research on everything.
You have to be an educated investor. I think that's my point. That's my point. That's very important.
I don't mean to cut short. I just, in the beginning, I asked you about, I made the introduction saying about your qualification and that you had a Series 663. Can Can you touch base on
Yeah,
that?
it's basically these are licenses that you have to get anytime you make any kind of recommendations or you advise clients on investment. So there are like Series 7, 6, 63. These are licenses usually are done by like financial advisors, bankers in banking industries, stockbrokers. There's few licenses are common, and then there are few specific to, like, if you're a stockbroker versus if you're a banker. So you take out these licenses. They're basically like any like licenses for anything. It's through SEC, which basically the agency is kind of in charge to oversee stockbrokers and investors and advisors. And you have to follow certain guidelines. Like, you can't invest on your own for yourself while you are at work, because you have to look out for clients' money first. Before you give any kind of financial advice, you have to make sure you look at their entire portfolio, their profile, ask them about their risk tolerance, figure out, and then make educated advices. Things like that. Is basically all these things are regulated, and in order for you to be educated and to understand, what kind of advisements you should be making, you need that education background. So these are like courses you take, you study for it, you take a written test, and you have to pass these tests. And once you pass it, you get those licenses. So that's what it is, and that's what that's why I was saying earlier that it's very different when you are licensed. You can't just make recommendations and advice, like, oh, invest in this or invest that, invest this. You really have to understand. And I think that kind of opened up my eyes towards being a better investor, like understanding your risk tolerance, understanding what investable asset is, understanding that you do need to take care of your own self first, like before everything, making sure that you have a house, your incomes are stable, that you have at least 6 months money saved up to at least take care of yourself for 6 months, so you don't get to that kind of financial trouble. And the money that you are investing is something that will allow you to invest and ride out if there are any sudden unpredictable downturn of the economy and things like that. So you could like, if, like, one of the things we would ask clients, like, what is this money saved for? And if they say, oh, like, oh, I want to buy a house with this money, we don't want to touch that money, right? Because today the market is hot, the houses are $1 million, you can buy it. But what if tomorrow something happens and house prices are $500,000 and you want to take advantage of that? But if your money is stuck in the market, you don't have that money to make that kind of decisions. And so, again, I'm not saying real estate investment is a better investment than stock market, but you have to understand what you value, right? For some, having own home is much more than just an investment. Having your own home, it's about accomplishment. Having your own home, it's about a safe place to stay and call it home, and a permanent address, and have your family grow there, building memories. So it's a little bit more than just investment. Right. So if that's priority and that's what you want to do, then that's completely okay. So that's what this license is for.
Now, because that's an extensive background when it comes to, like, when you have all these knowledge and experience, and you decide to say, I'm through with it. I'm through with the banking. I'm through with the financial sector. I'm gonna make a jump into the Department of Education. Like, to me, that's left. Like, that's far left from what normal. Because usually when you leave a financial sector, you try to go something within that field, or you still go into that business field. But nobody that I know transitioned and said, I'm just going to go into education.
I think, a lot of times we study certain things, right? Like I went to school. First, I went to school for engineering, and after a semester or two, it wasn't my thing. So I did economics and business management. And when I was doing economics, it's very hard to tell what do you want to do with economics major, right? So I got into banking. And then when I did banking, and I was doing quite well, like first year, I was the top banker in my market. And then I got promoted within a year to become a sales manager. And then another year I became the branch manager. and it was going really well, and it was definitely a pay cut when I went through education. But I think at the end of the day, having a job that you look forward to going, every Monday, and you don't look forward to Fridays,
Yeah.
kind of outweighs the money that you make. And like, I love teaching and I love going to work. I look forward to going to work, and to me, yeah, I'm making less money, but I think it's a good trade-off when you are happier going to work. Yeah, like you enjoy what you do.
Yeah.
Yeah. And I think that's what we should all focus on. You gotta, and it doesn't have to be teaching. It could be anything. And there are people, like, even when I was a manager in banking, and I would coach my bankers and stuff like that, and I would sometimes say, listen, no one is, you're not a bad person. It just might not be the right job for you. Right. You could be bad at one thing but great at something else, because you're just at the wrong place. With the right skills, you're in the wrong place.
Yeah. I believe I think his name is Jim Collins. I believe that's the author's name. He wrote the book Good to Great. And one of the things he said in the Good to Great book, there's some people that may be on the bus but on the wrong seat.
Right.
You're right. It's like, first you got to get them on the bus, get the right people on the bus, but then you got to figure out, are they in the right seat?
Right.
So,
absolutely. That's very, very nicely put. In the classroom too, like sometimes they're in the right classroom but in the wrong seat, and it makes a huge difference.
Yeah, that's key what you said about the kids being, when you have the right kid in the right seat, makes a big difference in the classroom.
It definitely makes a difference. And and what you were saying, people being in the bus and the right seat, and that kind of just made me think about my classroom as well. And it's true, even though they're all in the same classroom, sometimes the seat makes such a big difference, right? Like I seen students react differently when they're in let's say front right versus back left, or back right. Sometimes even their personality change, right? The way they interact with you, and people near them, people next to them, like they even influence the way they behave, right? So so many factors. So that was an interesting point, and just wanted to mention that.
I just have one final question before we wrap things up, because this is great. Do you see, because when I was going to school, we didn't have no economic class. Right. Do you see the kids today are more interested in investing than in the past?
Now, it might be a little biased opinion, because, for example, it's because of the course that I teach, it's an elective. So kids who sign up, they kind of have interest in these fields and in investment and stocks. So the kids that I see, that they are definitely more interested in investment and learning about stocks, male, female, both equally. And to me, it's like, oh, wow, these kids are definitely more interested. And it also could be that because I'm getting the kids who are interested to begin with. Right. But I do think that overall kids are a little bit more aware of investments. Kids are a little bit more aware of being an entrepreneur. Kids are more aware of resources that are available, like, for example, a lot of Robinhood are young traders, right? And it's possible because back in the days, you couldn't invest, or the investment platforms weren't that accessible. You had to have a lot of money, or if you didn't, they charge you like $10 per trade. Now you have all these great apps, all these platforms that allow you free trading, so you could start with $500 and not have to worry about paying $20 in commission, so, and then you have all these great websites, these apps, people are always talking about it, schools are talking about it, and then I think we are also in that culture, right? Like, when we talk about Tesla, Tesla is not just about car. No. When we talk about Tesla, a big part of it is how Tesla grew from nothing to this, $1,000 share.
Just like Apple. Right. Like, we in a generation where Apple's like a cult, right? Yeah. Everybody is either you Apple or we argue. We say like these androids don't want to buy into the Apple culture, but the reality is, it is either you Apple or you against everybody else.
Right. So, and and that's what I was saying is that, but it's more than just a company now.
Right.
It's not, when you think about Apple, it's not just what Apple products they make, but we think about how this company grew and what this company is about. When we talk about Tesla, again, it's not just about Tesla making cars, and I think we more talk about how Tesla shares just grew so much. Right. Same thing with Facebook and Instagram and Snapchat. Like, we were always talking about IPOs. We were talking about how the share prices are like this whole, tech shares, how they are changing the game of stock trading. And I think the kids are catching up to it. And also same thing with the being an entrepreneur. They see everyone is kind of like, it's all about making money, right? It's not back in the days, people wouldn't kind of flaunt about it, but you have like this Kim Kardashian family. It's all about kind of, the culture all started about being someone on social media so you could make a living out of it. Right. So that's why you see younger crowds are getting into all these videos, or they will try to do something, digital creator, brand ambassador, or this and that. Everyone is trying to be an entrepreneur, which is great. Right. Which is great. So I think the culture changed, definitely. Right. And I think to answer your question, kids are more aware. Kids are more interested in investment and being an entrepreneur. Absolutely.
Yeah. Well, I just want to say thank you. I was glad to have you.
It was a pleasure. It was a lot of fun. I think we talked about some great things.
Yeah, it was definitely a process today. And one of the things is, I just want to let people know that when it comes to entrepreneurship, a lot of people think it's just about running a company, but in my opinion, financial entrepreneurship is financial freedom. And if you can manage and operate the finances of your life, then you'll be better off. Then you have financial freedom. And to me, that's like another sense of being an entrepreneur.